Yeah, welcome back to this channel. Welcome back to this channel. We are continuing with business data analysis, and this time around we are looking at the analysis of the just concluded sitting August 2024, sorry, and we are looking at the questions that were tested, and you'll find that the paper was fair. It had a question on statement of cash flow, a question on management accounting, a question on loan amortization, and a question on auditing, and a question on pivot tables. Yeah, those were the questions that were tested this time round, and you are to do 3 compulsory questions. The first 3 in section 2, you are to answer all, and in section 3, you are only to select one. So if you are new to this channel, kindly consider subscribing so that you can be able to reach many, and those that have already subscribed, we say thank you. Thank you for subscribing for this particular content. So back to this question, we shall read through and we start tackling it. It was question number 21 under section 2 for 60 marks. So section 2 had 60 marks, 3 questions, each question for 20 marks. So the question reads, Mzalendo Limited is a listed company. The following financial statement relates to the company for the year ended 31st December 2023. We have the statement of profit or loss for the year ended 31st December 2023, and their shillings in million. Sales, cost of sales, gross profit, interest income, the expenses, distribution, admin, and finance, profit before tax. Then you have the income tax, profit after tax, dividend paid, the retained profit for the year, statement of financial position, the non-current asset, current assets, equity, then non-current liability, and the current liabilities, and total liabilities there. Then we are told in the additional, during the year, the company issued 10 million shillings 2 par value ordinary shares at a price which was 100% above their par value, incurring a cost of 2 million. So during the year, some items of property, land, and equipment were bought under a finance lease amounting to 56 million. Dispose of assets having a net book value of 38 million, realized 42 million. Depreciation charge was 74 million. Interest on finance lease of 6 million was included in the interest payable charged to the statement of profit or loss. So you are required statement of cash flow from Mzalendo Limited for the year ended that 1st December 2023 in accordance with IAS number 7 cash flow statement. So we look at that particular question that we are having, and I'll do it here. So Mzalendo, so this is Mzalendo. So Mzalendo Limited, statement of cash flow, statement of cash flows. So for the year ended that 1st December 2023, that 1st of December 2023. So that will be our question that we need to tackle. Can merge that and make it bold, that way. And we are dealing with shillings in a million. Shillings in million. And we said statement of cash flow is divided into 3 parts. And the first part is operating activity. Operating activities. And under the operating activities, we start with the profit before tax. That one we get it, or we find it in the statement of profit or loss. Here, profit before tax, and our profit before tax, in this case, profit before tax was 232. We deal with the adjustments, adjustments, of which it's not a must for you to write adjustments. Adjustments. And the first one, we start with what was included in the statement of profit or loss. We had finance cost. Finance cost is normally a financing activity. It's normally a financing activity, not an operating activity. So we add it back because it was deducted. We consider adding it back. The second one, I think I saw interest income. Yeah, there was this interest income, yeah, and that one was added. So we shall consider deducting it, the interest income, that way of -6. And the other one that we had, I think we had depreciation. I saw depreciation somewhere, depreciation, and our depreciation, yeah, here, depreciation charge was 74. Remember, depreciation is an uncash item. Yeah, depreciation is an uncash. So we add it back. And there was a disposal of assets with a net book value of 38, realized 42. So we had a gain, gain on disposal, gain on disposal of assets. And these assets, we shall take 42, we minus 38. We only need to get a gain. Yeah, so I can take the opposite because the gain is a negative. Yeah, gain we normally minus, so I'll take 38 net book value minus 42, and you'll get that we had a -4, which was a gain, because it's not in the normal course of business, and that's why we are deducting it. It was added as an income. Here we do reclassification. We shall report the entire amount. Yeah, the entire amount will be reported under the 42 will be reported under the investing activity, where we shall report the disposal proceeds. Yeah, we shall be able to report the disposal proceeds there. So the next thing that we had, I think that one already we have covered that. We look at under the statement of financial position, the non-current, specifically depreciation have been given. We have financial asset, we have the intangible. Yeah, when you look at the intangible assets, and we are not told about any disposal, it means there was an impairment, because in 2022 it was 8, and 2023 it was 6. So there was an impairment of intangible, impairment or amortization, impairment of intangible. Or I can talk about amortization of intangible. Let me just use the word impairment, there's no problem. Yeah, impairment of intangible asset, whereby here we shall take it -6. Yeah, so we had an impairment of 2, an impairment of 2, and I think that was all that we were given, and that was all. So shall get the total here for this one, the sum of this, that way. So get the cash flow before working capital, so the cash flow before working capital. So shall take the sum of the two. Yeah, and I'll put a top border here. Yeah, top border, that way. That is the cash flow before working capital. Then you go to working capital. And under working capital, we look at the current assets and current liability. Yeah, current assets and current liability specifically. Under current asset, we shall look at the inventory. I look at the three: inventory, trade receivable, and interest receivable, because it was put under the working capital, the interest. Then we shall look at the payables. Yeah, trade payables. The trade payables. So the interest receivable, there are two ways to account for it. You can either account for it under this working capital, or you can account for it under investing. Yeah, under the investing activity, of which both of them will be okay. You can account for it under working capital or under the investing activity, where we shall account for the interest, because you'll find that this is because of investment. we had this particular value. Yeah, we had this particular value, the interest, and therefore I may end up eliminating it here. Yeah, I may end up eliminating it here, the interest, and I just deal with this, the payable. So there are two, you can account for it under the working capital, or you can account for it under the under the financing, under the investing activity, because we have invested in order to receive the interest, and both of them normally say there is no any problem accounting for it that way. So when you look at the inventory, our inventory, the movement, in 2022 we had 330, but in 2023 we had what, 280. So we had a decrease. Decrease in inventory is normally an inflow. It's normally an inflow. Yeah, an inflow of 50. But for the other one, we had an outflow of 24. For the receivable, it was an increase. For the payable, we started with this and we ended up with 424. So it was an increase. So for payable, we normally do the opposite. We deal with it in the opposite side. When it is an increase, is an inflow. Yeah, when it's a decrease, is an outflow. Yeah, there are the only three of them. You get the sum of these, and you get the cash flow before tax. Cash flow before tax. Yeah, cash flow before tax. Yeah, the two of them. We add these two. I will put the top border. Then go with the tax. Tax paid. Tax that was paid. So for the tax, we find that we had only the current tax. We did not have the deferred in this case. We did not have the deferred tax, only the current tax. And we shall start with the end. Yeah, for us to have it in an easier way, we start with these. We close to the value of 58. The minus, the opening was 40. And we had to add the one for the income statement. Income statement, remember, they had deducted 64. So I'll use a negative in order to convert this into a positive. So that you'll find that we paid a tax of 46. And you can open an account if you wish to open an account. You can open. This one is a brought down. This one is a carry down. And under the debit, under the credit, we have the what we had for the year, what was set aside for the year of 64. And we'll get a payment of that. So get our net cash flow. So net cash flow from operating activities. So it's the sum of the two. Yeah, it will be 462. And we go to the other one, investing activities. And under the investing activities, we start with the disposal proceeds. Disposal proceeds from asset. So remember, we sold asset in note number 2. We sold an asset of 56, not 56, but 38, which realized 42. So we had proceeds of 42 that we had. We had interest income. Yeah, interest income. So this was an income as a result of investment. And for the interest income, remember at the beginning, we need to know what we received during the year. We had this interest receivable. At the beginning, we had 4, and at the end, we had 2. And for the year, so I will take this plus for the year. Let me pick this, and we minus what we did not receive at the end. So that means during the period, the interest income that we received was 8. Because we had the interest receivable, the balances that we are yet to receive. At the beginning was 4, at the end was 2, and we received 6. So that means out of the total that we received, that means the 8 was the total amount for that particular period. Remember, interest receivable is an asset, so the opening balance will be on the debit, and this will be on the credit, and what we received, we shall debit it. Yeah, what we received, we shall be able to debit. Yeah, so that is for the interest income. We shall revisit in case of anything the interest income, so that you can, if there is any mistake, we shall have to do that. But after that, those are two items under the investing. Yeah, under the investing activity, we are told so we had something, the PPE, and we had the financial asset. When we look at the financial asset, at the beginning we had a 0 and at the end of 190. So acquisition of financial, we had acquisition of financial asset, acquisition of financial asset, acquisition of a financial asset, acquisition of financial asset, and these are negative because it's an outflow. We acquired financial asset of 190, and the other thing that we had is a PPE. So for the PPE, they have told us something, that during the year some items of plant and equipment were bought under finance lease amounting to 56 under finance lease. So you can do some working on this end. Yeah, permit me to do some workings on this end. Workings, and the first one, let me open this, the PPE, so that you can be able to see what was happening with the PPE. So for the PPE, so here they brought down. So brought down for PPE, at the beginning we had 392 and carried down at the end. We had 544. Then these one are not at cost unless they tell you they are at cost. So that is net book value. If it is net book value, this side you shall have the depreciation. Yeah, the depreciation. Our depreciation was 74, and we had the disposal. This is depreciation, not separation. And we had the disposal. Disposal of that it at net book value. Then we had acquisition through finance lease. Yeah, this one in note number 2, where we acquired some items of PPE were bought under the finance lease amounting to 56. Yeah, finance lease of 56. And we had some revaluation. I think I have seen that. We had some revaluation. When look at the revaluation reserve, at the beginning it was a 0, at the end we had 14. It means we had some revaluation of 14. We revalued upward by 14, that way. And we've revalued upward by 14. So cash, what we acquired, will be our balancing figure. What we acquired will be our balancing figure. So this total will be 656, and this one will be now the difference. This we minus this, we minus this, and we minus this. You'll find that we had 194 as what we had acquired, 194 for the acquisition of PPE, So here, acquisition of PPE, and this PPE we acquired again is a negative, this one. So we acquired 194. I think that's all. And the non-current, we have covered the PPE, financial asset, and the intangible, and the interest income, and the disposal. So here we get the net cash flow. Yeah, net cash flow from investing activities. Investing activities. So get the total of this one. Yeah, that way 334. We go to financing activities. So here we deal with issue of shares and the rest. So here we shall look at the ordinary ordinary shares and share premium. Ordinary share and share premium. When we look at the ordinary, we are told during the year the company issued 10 million 2 shillings per ordinary share at a price which was 100% above their par value, incurring a cost of 2 million. So there was an issue cost of 2 million. So we issued 10 million. So if it was above, that means they were issued at 4 shillings. Yeah, they were issued at 4 shillings. And you will find that the ordinary, if they were issued at 4, here we are increasing from 22 to 40, an increase of 20. Yeah, an increase of 20. And that increase of 20 is because of the 20 that we are getting from the 2 shillings per, that we raised. So here we shall minus directly to 40 minus 220. That way we get the 20. And the other one for the share premium, we had 88. So it was an increase from 70. So an increase of 18. And the reason we are having 18, remember it's supposed to be 20. Yeah, it's supposed to be 20 here from the share premium. But when you look at the share premium, if I can just open the share premium account, just a share premium account to illustrate this. The share premium account. So for the share premium, what happened? Share premium. So for the share premium, so we have a brought down. So brought down, which was brought down of share premium, it was 70, and our carried down on this end, carried down was 88. It was 88. Yeah, carried down was 88. And the other thing that we had here, we had issue cost. Issue cost now will be credited here. We had issue cost of 2, and the cash, the difference that we received. Remember, we are supposed to receive another 20. That is what we are supposed to receive. But in this case, we did not receive 20. Okay. Just a minute. So if we were to do it this way, you'll find that it will give us a different value. It's giving us 16. And when we put it on this side, it will be 90. And when we minus, we'll get the 20. Yeah, we'll get the 20. That means that issue cost was not affected in this. Yeah, the issue cost was not affected in this account. But ideally, remember we issued at 100% above their par value. Share premium is supposed to have the 20. But that issue cost, I'm trying to see how they accounted for it. Because they received 18 instead of 20. And the reason, the issue cost was paid through this account. And I want to see whether we shall ignore the issue cost, but you're supposed to account for the issue cost. So then there is a two-way scenario to account for it in order to reduce the value. Yeah, because we incurred some amount. I will adjust this. Let me just cut that and paste it on this side. And this one, I'll eliminate it here. I will have my issue cost on the debit, so that here, so I'll find that the cash that you're supposed to receive was 20. Yeah, you're supposed to receive 20. Even on this share premium, we receive share premium of 20 first. Then from that we have issue cost. Issue cost of shares, I'll record it separately as a -2. As a -2, the cost that we issued, it's a finance cost because it was used to finance the acquisition first. We received a total of 40, then we issued 2 to reduce, and that's why the share premium you're getting, when you look at the difference of share premium, you're getting 18. Yeah, and the reason of getting 18 is because of that issue cost, because of the issue cost. Yeah, so that's how that issue cost was supposed to be accounted for. Then we had the other, so we are done with the ordinary share premium revaluation. So we are finding that we paid dividend, and in this case we don't have any other dividend under this. We did not have any proposed dividend, and you'll find that when you look at this, we had the dividend of 40 that was paid, and the retained profit for the year was on 28. So hoping here, when we add the retained profit, you'll find that if we can confirm, at the beginning we had this, and we add for the year, which was 128. Yeah, 128, and it is giving us 306. Yeah, you find that you're getting 306. So it is not adding up, because we are supposed to have 298. So there's a difference. Yeah, there's a difference because so the dividend paid was 40, and when we paid the dividend of 40, the 128, when we add it to the figure that we had of 178, then it's supposed to give us what? The 298. It's supposed to give us the 298, but when we add that, it is giving us the 306. It means there's some value that are not adding up here. Yeah, some value that are not adding up under the retained. So we shall see that. Let us first continue. We shall come and deal with those values. So the dividend paid. Let us first pick it directly. What we have as a dividend that was paid, of which it's not adding up. Yeah, we shall correct that. The dividend paid. Then the other thing is the finance cost. Yeah, you can deal with the finance cost. Finance cost falls under the interest. This interest, or before, yeah, we can, before the finance, we follow systematic order, and I'll first deal with the loan. Yeah, the 6% loan note, an obligation under finance lease, the two of them. 6% loan note and obligation under finance lease. Yeah, when you look at the loan, we had a decrease from 80 to 40, so we had a payment. So we had a repayment of loan, and for the obligation under lease, if I can open these as an illustration for the obligation under lease, obligation under finance lease. So for the obligation under finance lease, so we have brought down. There are two of them. We have what you call the long term and the short term. Yeah, so carry down long term, long term and short term, or non-current and current. So the long term, we had 84 at the beginning, and the short term obligation under finance, we had 6. The other one, the long term carry down, we had 100, and the short term we had 10. Then we had what we bought as a PPE. Yeah, we bought PPE under finance lease, this one, the 56. It means we paid what? The difference is what we paid. Yeah, the difference will be what we paid here. The difference is what we paid. So we paid, here, we take this, we minus this 2, minus the 2. So we repaid 36. We repaid 36 over our finance lease. 36 over finance lease is what we repaid. So here, the negative, this 36 that we paid, the obligation under finance lease. Obligation under finance lease. Where bank overdraft trade interest. Yeah. So for the finance cost now, for the finance cost, remember the interest on finance lease of 6 was included under interest payable. Yeah, that one is okay. It's supposed to be there. So finance. So finance, we shall deal with it plus the interest. Interest at the beginning. At the beginning of this, the interest payable we had 6, and we have for the year, which was 14, and we minus the carry down. So it will be the opposite. If I need to get a negative, yeah, let me just go with a negative directly. So interest, we had this, and we minus, so you open, so 4 plus what we had here, the 14, and we'll find that we paid 12 as our finance cost. Finance cost that was paid was 12, and that way we did not have any other, thing there. So current obligation, apart from the bank overdraft, which we shall use it as the opening. So the only thing that did not add up is this. 2 items we shall revisit, the interest receivable and this one, to see what is the problem with them. Yeah, but for the others, I think we have dealt with them the way we are supposed to deal with it, that way. So the only thing, we find the net here, net cash flow. Yeah, net cash flow from in financing activities here. So we add from this point, shall get negative 90. So get the net or cash flow for the year. Cash flow for the year. So the 3 of them, which gives us the cash flow for the year. We add this and we add this. We'll find our cash flow for the year as 38. Cash flow for the year as 38. Then we have the opening cash and cash equivalent opening cash and closing cash and cash equivalent opening cash and cash equivalent and closing cash and cash equivalent. So for the opening, I think we had cash and bank. So we had cash in hand and the bank overdraft, those 2. So at hand at the beginning we had 2, and we minus the overdraft of 40, which will give you a negative 38. And the closing we had a cash of 8. Yeah, so cash of 8 and an overdraft of 16. There, and you'll find that we have 8 as our closing balance. Yeah, that way. And you'll find that our balance or our statement will not reconcile. It will not reconcile because this is at 8 and that 8 is at 0. So we have to have 8 somewhere. So you'll find that the question is missing some values. Yeah, some values. And the value that is missing, and I think I had shown you under the retained profit. When you take 178 and 298, the dividend that they declared here, yes, they are showing that They had a dividend paid of 40. Yeah, a dividend paid of 40, but it is contrary, because when you take the retained profit of 128 and so you take 128. So if I can take these just for illustration purposes, you'll find that there's some values that are missing. Here for the retained profit. So the brought down was this one, 178. Here brought down was 178, and carry down. Our carry down here, we had 298. So for the year, if we take the profit for the year, just before the retained profit for the year without dividend, so profit for the year, profit after tax was 168. And you'll find that the dividend that were paid, is supposed to be this value, the difference, dividend paid. So if we add this and here, so the paid one, this minus this, you'll find that we paid 48. The dividend paid supposed to be 48 and not 40. So the 40 was what was declared under that, but the one that were paid was 48, because the retained profit is not adding up. Yeah, that's why here you'll find that there is a discrepancy. 306 is what you're supposed to have, but here we have 298. You'll find that there is a difference of 8, the one that we are missing. When you minus these, we are missing 8, and therefore you'll change these dividend. The dividend paid should be 48. Yeah, dividend paid should be 48 and not 40 according to the retained profit, and you'll get a negative 8 at the end of the year. So that's how that particular question was supposed to be done. The statement of cash flow. This is a question, it was question number 21 in the just concluded sitting. Yeah, so that's how the paper was supposed to be done. Kindly continue subscribing. Yeah, September intake is ongoing. Yeah, September intake, we shall give the correct date when the BDA class will be starting. So thank you for that.